for the month. So, this sort of pocket has moved to the back burner. Let's see how today shapes up. The first tick on the index is flat, very, very quiet. So, not moving the needle too much, hovering around that 18,750 level. The mid-caps are also absolutely quiet. The good part is that the advance decline ratio is in favor of the advances, at least at the moment. Big moves. Let's first check out what's happening with the banks because they've been the big laggards. Once again, the bank Nifty is down about 80 odd points. ICICI Bank is your top loser, followed by IndiCin Bank and then HDFC Bank. So this whole pocket is under pressure. Autos are starting to come off a tad bit now. The rally has been pretty smooth this year and this month. So autos, Maruti Suzuki is down. Eicher Motors is under pressure. So some profit taking is what you're seeing there. And metal names as well. Tata Steel is down about 0.5%, followed by a couple of other metal names, leading the way on the downside. Bajaj Finserv, Divi's Labs, there are a couple of other stocks that are in the red. By the way, HDFC AMC, after that block, is one of the big movers right now. So do keep an eye out on that. And IndiGo as well is up almost about 2%. HDFC AMC now rallying about 8% in trade. Talking about gainers, Apollo Hospital is your biggest index gainer right now, followed by SBI Life, Adani Enterprises, and some of the IT stocks are making a bit of a comeback. Wipro, Infosys are trending a tad bit in the green. Titan and Britannia are also holding up in the green. In fact, Apollo Hospitals has been the biggest mover this month. In the month of June alone, Apollo Hospitals is up 12%. And, we had very positive commentary from the management, Sunita Reddy, a couple of weeks ago about their digital arm. So that stock is now at almost 5,200. Big moves coming in there. But otherwise, for the market, very, very quiet at the moment. Timken India, there's a large deal that's taken place there and stock completely knocked down.
Yeah, that's something that Nimesh was alerting us about. In all probability, this could be, at least, this block could be perhaps the company's owners, the foreign parent, them looking to pare down stake. Of course, it's not confirmed. We have to wait for the end of the day to find the identity of the buyer and seller. But the buzz was that maybe some of this selling is happening because foreign owners are cashing out. By the way, check out IIFL Securities. These very strict observations coming in from SEBI barring the company from taking any new clients and, suggesting that there's misuse of client funds as well. 16% down. That's a huge cash on that one stock. Otherwise, the mid-cap market is very quiet. And this is what, we were highlighting at the start, that if the large-cap indices start falling, can mid-caps really continue their party? Well, their party has tempered off, at least for now. Let's see. It's early days. Mid-cap index is very, very flat for the time being. RVNL is down about 4% because of this Vande Bharat issue that we were just discussing. HAL, by the way, has gone into F&O ban. Stock is down about 2% as we speak. So these are some of the movers and shakers in focus. Titagarh Rail, because of what the management just told you. In case the RVNL part comes up for rebidding, Titagarh is interested. It's 5% up on that stock. Titagarh Rail Systems, yeah, there we go. Up and about. Those are some of the names that are hitting the headlines. Bank of Baroda, positive brokerage commentary coming in from JP Morgan. Stocks up another 1% or so. Actually, even Central Bank of India, some of these PSUs are not too bad. ICICI Prudential up about 1.5%. Lemon Tree, Varun Beverages, Sula. These are some of the other mid-cap names, but it's very quiet out there. The mid-cap index is absolutely flat. The Nifty is the one that's struggling a little bit with a 40-point cut for the time being. And once again, I guess we go back to blaming the banks because it is the bank Nifty, which is down 0.25% for the time being.
Well, what 40 points lower, 18,715 is where we are at on the index right now. So things are a little soft as we begin today's session. Now, just a few other names before we go any further. So IIFL Securities, we mentioned, is down 15% now. But it's interesting to see on the other side, something like an Angel One is perking up. It's up about 3 or 4% or so. That's a direct competitor, which is up and about. Now, HAL is down about 1.5%, coming up with very large volumes. Timken, of course, that block will happen. RVNL is down 4%. Mazgaon Dock is coming up with a small change. The Bajaj twins were very strong yesterday, both Finance and Finserv. Finance is down about 1% at start. Not just IIFL Securities, but IIFL is also down about 3.5% to begin the day. Again, mentioning because it's got large volumes. MRPL is down about 1.7%. It was a big gainer yesterday. These are just pullbacks after, basically some reversals from yesterday. Coforge is down about 1%. And you've got Max Healthcare, which is down about 2%. or so. Container Corporation, another one, which is coming up with some cuts at this point in time. The reaction on HDFC AMC is pretty interesting because the stock, of course, is the entire sector actually is completely derated over the last couple of years, has not done anything at all. And now there are these TER regulations, but at least the reaction for now, if it were to hold, suggests that maybe the big overhang was also this Aberdeen stake, which now is finally out of the way. And we'll have more on this on that in a bit. Olectra Green Tech is the number 2 gainer, volume-led gainer, by the way. It was a big one yesterday. It's up another 3%. And look at something like a Skipper. Skipper went up, I think, 15% yesterday. It's up another 7%. So in the broader market, there is a fair bit of momentum, which one is starting to see. Sonia.
I don't know how you read my mind, but I was going to comment on Olectra Green Tech. If you remember, Ravi Dharamshi in our editors round, okay, you weren't there this week, but
he's been a big.
He's very bullish on this entire EV space, especially the ancillary space, not the main OEMs, but Olectra Green Tech is into EV buses. And this year, Prashant, not even 6 months are over, the stock has doubled. It's literally up 100% since January because of, the kind of momentum that we're seeing in the EV space. So this is one theme that's really working out.
Absolutely. Yesterday we had Vijay Kedia with us, who was also talking about EVs as a sunrise sector. And of course, I mean, his big bet is Atul Auto, where, post-pref issue, his stake is about 20% now. So that's, that's what we have. Amber, by the way, is up 4%, 2,200 on Amber. So a few other names. So broader market, at least the breadth is pretty solid. 1,100 stocks are higher and about 800 stocks are lower. The Nifty is down 60 points, so it's drifted a little lower from the start as well. And the mid-cap and small-cap indices are also a little sideways for now. Well, let's welcome in Venugopal Garre. He's Managing Director, Bernstein. Venu, great to have you with us here. Good morning. Good to have you as always. Now, it's a market where you really don't want to stand in the way of momentum or the sentiment, which is very, very upbeat. At the same time, I mean, would you struggle to find large pockets of very clear undervaluation, Venu? So how does one approach things now? Go on.
Thanks, Prashant. I think you have summarized it well. When we start running out of bottom-up ideas, that is when we start to worry about market levels. At the same time, the flow perspective, especially FII flow, seems to be fairly decent. And I think India is also emerging as a very important sort of a country in the overall emerging market basket, which is basically another aspect which needs to be debated, whether it's a short-term sort of a view or a structural view that investors are taking. A lot of these flows essentially then leads to this positivity and momentum, which is what we are essentially seeing in the markets today. Now, our view primarily has only changed modestly. I mean, in some way, I didn't want to really stay away or stand in the way of momentum. About 3 months back, you would recall, last time when we were discussing, we had upgraded India to sort of a buy with the view that index should go to 18,500 levels. Now, that was actually an year-end view. And we ended up seeing that happening in 3 months. Or less than 3 months. Now, at this situation, I am of the view that I use this term called positive pause, which primarily means that I'm not looking for a deep correction in the markets, but there is a possibility that we hover around a similar range for Nifty, with room for short corrections happening, episodic factors driving those. At the same time, I think that the broader markets outside of the index stocks probably will continue to see momentum, which is where I guess people would seek opportunities, in terms of investment. So that's the broad roundup view of what I think about, at this juncture from a top-down level on India.
So you spoke about a positive pause in the market. So perhaps what we call a time-wise correction, right? Not so much a price-wise correction. Got that. Venugopal, morning. I have to ask you what's happening with the banks because, there's this steep fall that we've seen in the month of June. Stocks like Kotak Mahindra Bank are down 10% already. And we're not even done with half of the month or with the entire month rather. What do you do at a time like this? Do you buy this dip or do you stay away entirely from the private sector banks?
My viewpoint is, I think the market's viewpoint primarily is very centered around how they're looking at, the top-down valuations as well. The general thinking is that, larger banks, given what our expectations of credit growth this year, the lack of room for earnings upgrades, for example, doesn't really necessarily mean earnings downgrade revisions, but essentially about lack of room for earnings upgrades and where they are on valuations. I think there's a broader thinking that perhaps they're fully valued, which is what is broadly reflecting in the underperformance, which has basically happened year to date. Now, my viewpoint is that, given a slightly positive view that I have over I would say a 2 to 3 year view, or even a 12-month view, I would be a buyer of these sort of declines in some of these large cap banks. And my perspective simply is that if at all, if people think about red flags, this is more about the broad basing of credit growth. Now, so if you were to think about it, if consumption, things like unsecured lending, if that has been essentially been the drivers for credit growth, eventually it has to move and become more industrial led, not necessarily just industrial working capital led by inflation, but more industrial led by capex. And these things essentially take time. But I think the market comfort would essentially come through when that transition happens. Now, this transition essentially on its own will not happen in 3 months. It is going to take about a 12 to 24 month view. So if you are essentially looking at playing that trade, I think it is a good opportunity to essentially buy into these banks. They've underperformed. And I think the cycle is going to be positive for them over a 3 year view.
Okay, so keeping the faith on the banking side of the market, Venugopal, hi, good morning. Let's talk consumer as well, because I guess that's where everyone's now trying to see if this rural revival is for real, but we have questions on the monsoon right now. So, what's your overall thoughts, thoughts and sort of positioning on the consumer side of the market? And if you could break that up between urban discretionary and let's say some of the more ground level rural FMCG part of it.
Yeah, so I mean, consumption has various subparts to it. I think on an overall level, I am still sort of underweight on consumption. And in the sense that from a growth standpoint, my viewpoint is consumption may not necessarily throw major positive surprises. And remember that the start for the monsoons has not been that great. So there are some risks around what might happen to agri GDP growth rate, which is, of course, got a deep link with how monsoons shape up. So at the margin, what we saw positivity in terms of rural spends in the initial part of the year, perhaps we could see a situation where things might moderate, in the next 2 or 3 months. Now that's essentially probably, worrying sign. Now, I would probably argue that within these elements of broader consumer, the areas which I have actually been pushing or been positive on are more linked to things like appliances or electrical products, which could be those products associated with the real estate. So that's an area essentially I'm positive and overweight on. That's a change that we had made a few months back. FMCG in general, very hard to argue for incremental positives given where they are on the valuation cycles. I would still be underweight pure FMCG. Autos, which is another leg of consumption. This part, I was more neutralish and trying to play with certain stocks in the basket. Of course, it's a positive sort of a view on autos, but neutralish because of specific, sort of areas where we weren't really positive on. But at this juncture, I think we're reaching a situation where it's becoming hard to digest even valuations for autos across the board. So incrementally, I guess the returns will be quite relatively more muted even in that particular sector. So that's a broad, probably picture I would sort of place. If at all, I would probably argue that discretionary outside of all this, I guess might still be a bit sluggish because inflationary risks, while, sort of are receding, but then aspects such as inflation rearing up back again because of food and other things might be a risk which might play out later in the year.
What about some of these spaces that have come back after a long time? I mean, defense, of course, has been the flavor of the season now. But there are so many other pockets, right? Auto ancillaries have come back in a big way. Electric vehicles, we were just discussing that theme a while back. Anything that you like from these so-called new age themes?
No, I think we like a lot of these themes, but there are some themes which are getting priced in. For example, defense, I've been positive on it for almost a decade. And looking at where they are currently on the valuation curve, very simplistic view, if you were to think of defense, the idea was that indigenization essentially will drive faster growth for local companies, especially the SOEs. If you were to look at 8-9% long-term growth historic from a top-line perspective for the overall defense spends on the capex side of things, now these companies are already pricing in more than double of that. Look at where they are on valuation curve. So I think The defense theme is fizzling more for me from a point of view of valuation than essentially the story itself. The second theme, essentially on the EV side of things, I'm very, very positive. I would be of the view that mainstream EV companies are yet to emerge. So people are trying to essentially play whatever is linked to EVs at this juncture. And one should be really cognizant of that. Essentially, some companies which are just assemblers and conduit for Chinese companies, without mentioning those names, I think one should be extremely careful about sustenance of those rallies for those companies. I would still wait for some of these incumbents and mainstream EV companies to emerge to essentially call that as a relevant sector. Manufacturing is another area where I'm really positive on, especially the China plus one theme. There would be a broad basing of opportunities essentially that I see around that as well. And that's a pretty long-term theme, so you will always see volatility around that. So these are probably the three things that I want to mention as the area. So,
Venu, have you? The institutional investors, they have certain criteria in terms of market cap, volumes, etc. And that kind of, in a market like this, because there are newer sectors emerging as well, right? Smaller companies which cater to, as you yourself said, one has to be more careful there because they're not established in the electric vehicle space, for example, and other areas. So, I mean, do investors want more ideas down the market curve? I mean, just trying to understand, because there is new energy, there is electric vehicles, defense, for example, there are lots of smaller companies, not the big ones like BEL, where there is institutional coverage. But is there interest down the market cap curve?
Yes, Prashant, I think somewhere down the line, I think broadly, globally, investors have realized that one of the most important ways to play India as a story is not just through large caps. Otherwise, it always used to be the top 50 or 60 companies. So the interest in trying to achieve those opportunities where you could essentially sit with companies and get your multi-baggers essentially comes through the next 50 or the next 150, right? So we don't really see too much of interest in a 300th rank market cap stock, but essentially outside of the top 100, the next 150, there is immense interest because people do still want to essentially achieve some part of the portfolio linkage to those sort of stocks, which can essentially give them, sort of the extra return over the index. So that's, I think, given. And I see that actually getting broad-based across the world. So that's the situation at this juncture. But at the same time, I would probably argue that, somewhere down the line, these new opportunities that come through, there are some areas where I see much more tangible interest. So for example, something like EVs, there is always active participation in trying to figure out what to buy. Similarly, manufacturing in general, fairly active participation. Manufacturing could be EMS or could be an existing manufacturer doing, let's say, even chemicals, right? So that's like a fairly broad industry. But, at the same time, new energy, I think there is a divided opinion in terms of quality of companies and what to play, whether it should be a utility or a manufacturer. And I guess probably, I think the opinion is very clear that people want to still figure out and play manufacturers rather than trying to play utilities because there's some always regulatory issues which emerge, right? So there people tend to discern about what to buy and what not to buy. And similarly, just to highlight EVs, as I mentioned, want to clearly clarify that while people in the lack of opportunities might be buying whatever appears as EV at this juncture, if you are a company which are just a front for a Chinese EV player, I think those are companies which won't be sustainable. Eventually they will find regulatory issues.
All right, we'll leave it at that. Thanks a lot for joining in, Venugopal. Appreciate your thoughts. By the way, I just want to point out that the market has taken a big turn for the worse. So after yesterday's steep slide, that caution has been taken forward today as well. The Sensex is down 300 points and the Nifty is down almost 100 points. It's given up on 18,700 with a lot of ease. And don't lose sight of what's happening with the Bank Nifty. The one stock that I just want to point out is IIFL Securities. Now, we spoke about that in our top 10 segment as well. But the stock is down 15% after SEBI prohibited IIFL Securities from taking on board any new clients for the next 2 years. So, because of that, the stock is under a lot of pressure. But overall as well, the market, deep shade of red now.
Yeah, absolutely. I mean, it's in sync with what we're seeing across Asia. This is not an India-specific thing. We should pull up the Hong Kong market actually once again. Look at this. China has cut rates along expected lines, but markets in a very different mood. Global markets are in a different mood. Hong Kong's actually down about 1.5%. So profit-taking seems to be the order of the day. Let's see. Now, we have to wait for the mothership when the US markets reopen for business today and see if that can change. But right now, it just seems to be a very, very cautious outlook. Maybe it's this is pricing in the reality of more hikes ahead. I mean,
the Hang Seng market, I think, is very focused. I mean, the reaction is because of China, because I think the cut has happened, but it is lesser than expected.
It's only 10 basis points.
There has been also expectation that they will announce many more stimulus measures.
The fiscal stimulus.
The China market goes into holiday starting Thursday. I mean, it has to happen before that.
Right.
Otherwise, I think the Hang Seng market perhaps is
the extra
very specifically China.
Absolutely, fair point. I mean, everyone's waiting for these property market measures in China. I mean, that would be the big thing. And right now, we're seeing only incremental cuts. So absolutely take your point, Prashant. Perhaps that's where the disappointment seems to be coming in from. We've got an eye on the screen for sure, but let's also continue the corporate conversations. That's a Nifty for you. It is a big slide. And like we were pointing out, when the headline indices start falling like this, can mid-caps really remain resurgent? Perhaps not. So there's profit taking in the mid-cap market as well. That is the order of the day. It's a red screen across the board. But let's keep the conversations going on the corporate side. And Star Health is the next corporate on our radar. The company's net earned premium in the fourth quarter was up by about 11%. The company's been guiding for a premium growth of above industry levels as well for this year. And they seem to be quite optimistic of an overall good performance in FY24. Anand Roy, MD at Star Health and Allied Insurance, is with us. Mr. Roy, thank you for joining in. I just want to start with the May premium trends. And if we look at it, I think the health insurance, the standalone health insurance industry saw a premium growth of about 23%, if I'm looking at the right numbers. Your growth was around 16%. Tell us what the outlook is. I mean, what are the average monthly rates that you will target, given that I think there's been a fair amount of price hike as well. Are we done with most of the price hikes? Will we see more this year? And what is your outlook on the monthly premium run rate?
Morning, and thanks for having me on your show. So our outlook for this year, we believe that we should be able to deliver a 20% plus growth rate in our premiums. And that's what we are clocking as on the YTD numbers, which is higher than the industry growth rate on the retail side. The industry is growing at around 18%. We are growing at 20%. On the overall basis also, we are clocking a 20% growth. So I think that's the momentum we would like to maintain for a medium to long period of time. You know, the intention and the aspiration is to maintain a 20% healthy growth and also have a reasonably good combined ratio of 93 to 94%. And if we are able to deliver both on these numbers, I think the company should be, able to deliver a 20% ROE on a consistent basis. I think these are the numbers that we are trying to achieve, and we are planning our strategies towards that.
So, Mr. Roy, just to understand, when you said 20% growth in premiums for this year, is that largely volume growth that you're talking about, or you're also expecting or building in an element of higher prices, higher premiums? I know I've been paying more for my health insurance, for instance.
So premium hikes, we have taken a premium hike in one of our leading product, the Family Health Optima, and that will play out throughout this year because that effectively came into being from May, that is last month, for our existing customers. So I think for the next 12 months, that will play out. We are seeing, reasonably good trends. The customers are remaining in the franchise, and we are tracking that very, very closely. So I think the premium growth, the growth will come from both, as you said, from the volume growth as well as the value growth on maybe on a 50-50 basis. But that's what we are trying to do. Yeah.
Anand, our team points out that a similar price hike, which was taken back in 2017, did drag renewal rates down by about 4-5%. Have you, because this came into effect on the 1st of May, this price hike for the Optima plan, have you seen, I mean, it's too early, but have you seen anything of that sort, and do you expect a repeat of what you saw back then?
So Prashant, yeah, that's right, because typically we do see, we would expect a 4 to 5% drop off in our, probably some customers, but we do not expect any downturn in our overall premium because if there is a 3 to 4% drop off in our customer from this particular product, the overall premium rates would remain better than what it was last year in terms of because of the price hike. So that is already built into our strategy. We are trying to minimize that to the extent possible by convincing our existing customers to, if they're not interested in the FHO, they can migrate to one of our other products. So I think that's already on. We hope to, reduce that impact to the maximum possible.
Okay. Also, I guess, on your strategy has been increasing market share, right? Because your retail market share has gone up to almost 35% now. What are the steps you're taking to increase it further? Is it more to do with geographical, rural penetration? And, what kind of market share are you targeting, say, by the end of FY24 and 25?
So, Sonia, we have been focusing on the semi-urban and the rural markets in a big way. More than close to 25% of our business already comes from these geographies, and we are having a very, very intense focus on that. We expect to open about 1,000 new sales offices in the semi-urban and the rural markets and increase our penetration in those areas. I think it is also aligned with the regulators, strategy to increase penetration in the country. So we are looking at the Bharat, as you may call it, rather than only focusing on the urban markets. So maintaining market share definitely is an important, strategy for us. As you rightly said, we are at 35%, which is way above the other competitors. But growing it from there by growing faster than the industry, I think we should be able to accumulate the market share slowly.
So this, increase in the rural footprint that you were talking about, right? Earlier you had told us that you're looking to do that via more bank assurance tie-ups and agency channel tie-ups as well. Tell us a little bit about that, because I think the contribution of tie-ups with corporates and banker channels has been about 43% in FY23, if I'm not wrong. How much could you take that up to by the end of FY24? And is that your main strategy with which you'll sort of increase your rural presence?
So it's a mix of both. We have a very strong agency network. We have more than 650,000 agents who work for us across the country. So in the rural markets, obviously the agents will continue to play a very big role. But on the bank assurance side, as well as other partnerships that we are having, which is growing very fast for us, I think, they will also start contributing. As a matter of fact, we have recently signed up with India Post Payments Bank, and they have a very strong rural presence. So we hope that, partnerships like these will bring, more momentum in our rural drive. So it is a mix of both agency and non-agency channels that will give us the momentum.
Okay, we'll let you go on that note. Thanks a lot for joining and appreciate your thoughts. That's the word coming in from Star Health. Let's slip into a quick break. On the other side, we'll connect with the management of Endurance Technology and find out how export markets are doing. Remember, that's been the big theme across most OEMs, a pickup in exports. Ramesh Gihani, the Executive Director and CEO of Endurance Technologies, will be joining in to give us an outlook on the business. We will also connect with Vinod Agarwal, the MD and CEO of Volvo Ashok Commercial Vehicles, to discuss about Volvo Ashoka's deal with BHEL to come out with the hydrogen cylinders for commercial vehicles. More on that coming up in a bit. Welcome back. As promised, Endurance Technology is the next corporate joining us on the show. Now, if you look at the commentary from a lot of OEMs in the past couple of weeks, the narrative is that exports are picking up. Endurance gets about 25% of their business from the European markets. Earlier last year, the market was very challenging. But in Q4, earnings actually picked up because of the fall in energy prices. Ramesh Gihani, the Executive Director and CEO of Endurance Technologies, joins us now to give us a sense of the demand environment. Mr. Gihani, always great speaking to you because we get to learn a lot about the industry, not just about your own business. Is the worst of the export problem behind us? Not just the problem with energy prices, which has of course fallen, but demand in general. How is it at the moment?
Thank you, Sonia. Good morning. It's a pleasure talking to you too. Well, as far as export is concerned, right now, what we see in Europe, what is happening is that, yes, the registrations are increasing, the numbers are increasing. Like the increase was around 17% in the month of April. But the other sound bites that are coming in is that Europe is worried about inflation. They're not used to the inflationary part, which is close to 7.5% right now. And, because of this reason, people are not buying vehicles. What is being sold presently are those vehicles which were booked probably 18 months back. So the sentiment is a bit low, but I would say that the numbers are coming back. I would always like to look at it from an optimistic view. Yes, the numbers are coming back, right? This inflation, I'm sure they will be working around, the governments and the industries will be working around that, and things should ease out probably in the coming days. As far as energy prices are concerned, yes, they have considerably come down, significantly come down, which is a very positive sign. In Q4, probably the incentives or the payback which came from the government agencies and others was a big help, and that's why you must have seen that the numbers of Europe have increased and the margins have also increased.
So what does this mean, Mr. Gehani, for margins in FY24? I ask because, in Q4, your European business margins turned around quite a bit, as you said, because of lower energy prices. It's almost at 18% now. Can you do better than that? Do you have more margin levers, particularly for Europe in FY24?
Yes, why not? Because currently also, if you see, the energy prices are just about double than what they were in FY19. So if that eases out, you can see that the margins would further improve in Europe. Secondly, we've always been at those levels, 18 to 19% in Europe business. So I see absolutely no reason why we cannot reach there as the situation eases out further on energy prices.
Mr. Gehani, and overall margins between 13 and 14%, sir, for the full year, that is doable?
For endurance as a whole?
Yes.
Or,
as a whole.
Yeah, why not? See, I think Prashant, I explained this to you last time also. Endurance is a very focused company as far as margins are concerned. There are some challenging factors which are hitting us also, like energy prices in India have also gone up, PNG prices have gone up. But the kind of work that we do behind to keep our costs under control, I see absolutely no reason that why we should not be improving our margins in the coming years.
Mr. Gehani, hi, morning. Just want to understand where your EV order book stands right now. And also, as you go about executing the EV order book, in terms of a revenue mix, how much of the business is going to be EV and how much will be non-EV? If you could maybe give us a projection for FY24 and more importantly, say FY25, 26 onwards.
Yeah, good morning, Surbi. Our total order book for EVs is just about 600 crores, and out of which 378 odd crores was booked in this year. And that's primarily on brakes and castings and the suspension business. So this is what we have acquired so far, and we are in very, very active discussions with our prospective customers, and we've got very promising numbers coming ahead as far as the order book is concerned. It's just about winning them and and putting them into execution. We've already started our brakes business for our customers. We've already started suspension business, so that is going on pretty okay, and I personally believe as the electric vehicle momentum gathers up, we'll be able to increase these numbers.
So I just want to understand in terms of margin profile as well, as you scale up on the EV side of the business, is that a better margin business at all? Or it doesn't really matter whether it's ICE or EV for you in terms of profitability and margins? Are both segments the same?
See, that's a fairly good question, right? Let's try to understand that the configuration of the vehicles are different. So obviously the products that we supply are a bit different than what we supply otherwise. So in that case, some profitability improvements we have over ICE, but not as significant that it can make a considerable difference of pricing, or margins. But they are definitely better than ICE.
Okay, better than IC engine margins. Of course, we understand that, and that overall kit value also goes up for OEMs and for yourself. I want to also understand what does all of this mean for FY24? Because FY23 ended with a revenue growth of almost 17%. You're now sitting on a base of almost 9,000 crores in terms of revenues annually. How much can you do in FY24? Will it be another 17-20% growth? Can you do better than that? And will a large part of the earnings come in from exports? Or are we looking at the domestic business picking up as well? Because here in the domestic market, the revenue growth has been in single digits.
See, there are 2-3 levers to this answer, to this question. One is that the overall industry did about 19.51 million vehicles last year. Currently, they're floating at the same average, 1.59 or 1.6 million vehicles a month. April did 1.59, but May did 1.73 million vehicles. That's one aspect of it. Within the current circumstances of exports being subdued, or the exports not picking up as much as they were previously. So as the export market comes back, right, we can see a lot of numbers getting added. And for that, nobody has to add any capacities. These capacities are already available. So ramping up further numbers because of the export going up in South Africa and in Latin America markets, all these things are positive levers towards improvement of revenues. As far as the OEMs are concerned, we have...
Sure, I'm just running short of time. Can you give me one number? Are we looking at perhaps 10,000 crores of revenues in FY24? That would be about a 15% jump from FY23. Is that a reasonable assumption?
Well, you know very well that I don't give forward-looking numbers, but 10,000 crores is only a number. Why don't you think that we can even surpass that?
Now, I'm being conservative. You don't have to be. You can do even 20%. That's what I'm asking you. I mean, can you do better than what you did in FY23?
Well, we've always been saying that we'll outperform the industry, and that will be our continuous endeavor. How many percentage more or something? That's only time which will tell.
Okay, Mr. Gehani. Good chatting with you. Thank you very much for giving us a sense of on how your export business is shaping up, EVs, the entire gamut. Thanks for joining in. Well, we're sticking with conversations from the auto space. Volvo Ashok CV has tied up with BHEL for hydrogen and CNG cylinders for commercial vehicles. We have Mr. Vinod Agrawal, MD and CEO of VECV Eicher Motors, with us to discuss this. Thanks very much for joining in, sir. So first things first, can you tell us a little more about this tie-up? What's the revenue potential, and how will the revenue be shared? What's the revenue and profit share in this JV?
This is fundamentally a joint development project for CNG and hydrogen cylinders, fuel cylinders. Currently, if you look at CNG cylinders, are all steel cylinders. But we are tied up with VHEL is that they will develop latest technology type 4 composite material cylinders, which are very lightweight and latest technology. And they will also develop the hydrogen cylinders. So these are the latest technology cylinders, and currently this technology is not available in India, and it will take around 2 years' time to get to the production stage. And by the time you will also have the hydrogen gas availability or infrastructure also will be better. So therefore it is very difficult to tell you about that, what will be the revenue or the implications on the overall profitability. But at the same time, this is for the future technology and for facilitating alternate fuels at the right cost and at the right technology. So it's
Sure, Mr. Agrawal, good morning. A lot of commercial vehicle players like yourself, Ashok Leyland, are going big in this alternative energy space. So I get that hydrogen fuel is the way to go. But, I guess my colleague was also asking you to understand whether there is any kind of investment that you would have to make in this. You said it will take 2 years for this technology and this whole process to come through. But in those 2 years, any investments that have to be made from Eicher Motors' side?
We are making investments in the hydrogen technology as such. As far as BHEL is concerned, they are making investments for development of new composite material, hydrogen and CNG cylinders. So they are doing one part of it. The entire other thing, investment is being made by us.
So again, sir, just to understand the math, the end product will be these hydrogen cylinders, which will find application in the CV space. So the investments pretty much happening 50-50, is it 30-40? And my similar question for revenue, whenever the revenue kicks in, you said it's 2 years from now, is it a 50-50 revenue share, or what are the terms of engagement here?
No, it's not revenue share. We will be buying these cylinders from them. They are going to develop and manufacture. So they will become the suppliers of these hydrogen and CNG cylinders, which are very lightweight, and we will save on the payload. Like our trucks will be able to give better payload with the lightweight of these cylinders. For example, the CNG cylinders today, we lose payload of around, you can say 700 or 800 kilograms in a truck. With this lightweight cylinders, you will be able to save that weight. So they will be the supplier. They are developing this technology, and we are going to jointly participate with them, and then we will buy these cylinders from them.
Okay, got it. Let's move on now to the overall business as well. Just a couple of, checkpoints for you. The month of May was very good. It was almost a 12% growth that you saw in the commercial vehicle sales. How is June and July shaped up, or how is June shaped up, and what's the expectation for July in terms of growth?
Commercial vehicle industry per se is in the, I would say it's in good shape, even though first 2 months figures are not very encouraging as far as the overall industry is concerned. But there are reasons for that. There is no, you can say there is no macro reason for any concern. The industry is growing, and it should continue the growth path. Fundamentally, the first 2 months, one thing was that there was changeover of technology to OBD2. So whenever the technology change happens, there is always some sort of, uncertainty, or people wait and watch. The second reason is that there has been a lot of, you can say, focus on reducing the discounts across the industry, because discounts have been hurting the industry very much over the last few years. And of course, there is a good realization that it cannot go on like that. For example, we have not been able to recover the right. We have not been able to pass on the cost increases in the past. So now, therefore, if there is expectation of better prices or passing on of the cost increase, so there is some resistance coming from the customers. That is the reason for first 2 months that why the industry figures are not that encouraging as it was last year. However,
Sure. For the full year, sir, you had said that FY24, the industry will grow in double digits. And I think that is the view echoed by your peers as well. When you talk about double digits, what would it be? I mean, would it be, in high teens? Are you looking more about 10, 15% growth? And where would Aisha feature on that list? What kind of growth would you do in the full year?
It will be a different percentage for different segments. For example, for buses, it will be very high double digit. Buses already, first 2 months also, the growth has been more than 30%. So the buses which had been low, even though last year buses was very good, and some of the bus segments also were at a new peak. So this year also the buses demand is very good. Heavy duty trucks also, the growth will be better than the light and medium duty trucks, because heavy duty trucks are still away from the earlier peak. So therefore you will see, you can say, better double digit in heavy duty trucks as well as in buses. But in light and medium duty trucks, the growth will not be that high.
Okay, so overall, can you leave us with a rough estimate? Talking about the overall CV portfolio, growth of 15, 10, 12%. Any rough range that you'd expect?
I think you can take 10% plus.
10% growth in CV sales this year. All right, we'll remember that, Mr. Agarwal. Thank you very much for joining in. You have a good day. And we look out for the next conversation that we will have. Thanks for joining in. Well, with that, we do have to take a... Actually, we have Mitesh with us now. I think we can go to him. Mitesh, so I think it's a slippery market. So what is the advice from here on? Though now the Nifty is trying to find some ground. What's the sense?
So I think, as I said, the market lacks momentum, but fortunately we haven't had a breakdown below this 18,670 mark. We did venture 2 points below that on an intraday basis. But let's see, if in case we get an hourly closing below that, and to my understanding, I think that's a stronger probability given the fact that, the intraday indicators are turning south and the volatility indicators are turning up. So I think once you get an hourly close below 18,650, 660 zones, then I think, a corrective movement to 18,550. That's the minimum, but logically I would expect 18,480, 450 zones to be tested. So I think next couple of days could be slightly choppy with mild bias on the negative side. A pullback to the 20-50-day averages could happen. Therefore, I think, we maintain our bias of cutting down on long positions and exploring short ideas. So I have Concor as a stock recommendation. That's a sell with a stop at about levels of 650. Look for targets of around 600 over here to begin with, and maybe even lower levels can be tested. And the other one is a sell on Ambuja Cement, which also, has given a negative kind of a trigger on the hourly chart. So here, sell with a stop at about levels of 455 half for targets of around 432.
Okay, that's on Ambuja Cement. I wanted your thoughts also on Interglobe Aviation, Mitesh, because that is that stock has hit a fresh lifetime high today. I agree that it's already up about 60% in the last 12 months. So maybe a lot of the juice is out. But do you still see more upsides here?
Looking at the medium to longer term charts, I'm extremely positive on interglobe aviation. I think the big thing what happened above levels of 2200, and since then we have seen the stock keep making newer highs. I think a medium term target is around 2850 over here, so good upside left. And if somebody's holding it out, I think keep a stop below 2330 as a positional stop loss, and I think maintain your long positions.
All right, we'll leave it at that. That's Interglobe Aviation. The market cap of IndiGo is now at 94,000 crores. So it's up almost 60% in the last 12 months and almost inching towards the 1 lakh crore mark in terms of a market cap. Let's do one thing. Let's slip into a quick break. On the other side of the break, we'll shift focus to the commodity markets. Manisha Gupta will be with us. We'll also talk about some stocks that are on the move. Stay tuned.
Welcome back. So for the equity markets, it has been a bit of a downward morning. 50 points lower on the Nifty, slightly better off than where we were, let's say, at around 9:30. But it is still a day of decline so far. Let's, however, look at the commodities universe and figure out what the action there is like. Manisha is back with us. She's in the studios now. Manisha, what do you have your eye on?
Well, I'm looking at metals as a sector, but more towards precious metals and then some towards base metals. I'll start with gold prices, where we are trading around $1,950 per ounce right now. Remember, for this year, we've seen an all-time high of 2,050 as well. So we've seen quite a bit of a decline coming in from those kind of levels. And then apart from that, it is also the fact that you're trading at a three-month lows there. China cutting its prime lending rates for 1 year to 5 years by 10 basis points. It's something that seems to be weighing onto the markets here as well. And then apart from that, this one done, the next thing to watch is going to be the US Fed Chair Powell testimony before Congress. That's happening tomorrow. And on Thursday, you have Bank of England monetary policy meeting, where the expectation is that you could be looking at 25 basis point of a rate hike coming in. But more important to watch is the CFTC data, because that tells you on what the fund and money managers really seem to be doing. So the speculative longs are at a 3-month lows when it comes to gold prices, is the reason it seems to be meandering around these levels. So when you look at the overall contracts, we've seen longs go down by 10,000 contracts, but even then it's a big number at 110,000 contracts, which are still on the long side. So when you look at shorts, that has continued to increase by 8,000 contracts here. So shorts in any case is less in number, and that is the reason you have gold prices trading around these 1950 mark. Silver on the other side really seems to be trading on a stronger side. So $24 per ounce is where it really has been holding. 10 to 20 cents down or up is where it has been holding its range for last month or so. Here, the speculative longs have increased by 30% in last 1 week. We've seen longs gain up by 1,400 contracts, and the shorts as well have come down. And this also is a strong number of around 1,200, 1,500 contracts in front of you. Copper prices, trade a look at that, because we're trading at a near 1-month highs when it comes to copper as well. Here, the longs have risen by 5,000 contracts. This is as per the CFTC data. And here, the shorts also have seen a bit of a decline. So the copper prices, after hitting almost a 7-month lows, are trading at a 1-month highs right now. The China, what they've done in sense of interest rate really seems to be supportive, with markets anticipating that you could be looking at further liquidity injections, and that clearly has been yet another supportive factor.
Okay, thanks a lot for that, Manisha. So that is the commodity space. But let's do one thing. Let's talk about equities. Yet again, HDFC AMC is by far the stock of the day. Nimesh is here to tell us more about that. He's also talking about Timken this morning. Nimesh, over to you.
Hi, Sonia. I'll start with HDFC AMC first. A big reaction to the stock after a large block deal. The stock is up 5-6% after the block got executed in the block window, which means there was zero slippage, and the fact that it happened just at a 1% discount versus the anticipation of a 5% discount. So that's the reason why you're seeing a sharp reaction to the stock as well. In terms of information, Adani has sold out its entire 10.2% stake in the company. And in terms of buyers, I understand some domestic mutual funds and a leading long-only fund was an anchor investor in HDFC AMC block. Now, in terms of further implication, because Adani was classified as a promoter and now they've sold out, the free float goes up, which means early next week, FTSE is likely to increase the weight on HDFC AMC, which would lead to an inflow of close to $17 million. But the bigger event to track would be the MSCI, how that treats the stock. Now, there are some sales notes which suggest that the stock, HDFC AMC stock, has to react another 10% on the upside for a possible inclusion in the August reviews. That's the overall analysis as far as MSCI is concerned. So the news is Adani has sold out completely, so it's a clean out trade, and some good funds have bought. Now the action to watch would be what the FTSE does and what MSCI does. FTSE should happen next week. MSCI should take some more time, and the August review is what is likely to include HDFC AMC into MSCI.
Okay, all right, got that. Thanks very much, Nimesh, for the details there. That was a big highlight in terms of the morning block trade action. Manglam is joining in. I think he's watching out for Concor. What's happening here, Manglam?
Well, Container Corp is lower in today's trading session. There's an interesting note which has come in from Kotak, where they've downgraded the stock. They already had a reduced rating, and now they believe that it's time for downgrade to sell. Though they've maintained their target price on the stock at around 610 rupees. That's largely because they've rolled forward the estimates from FY24 to FY25. The important part about this report is that they're sensing a zone of margin correction and uncertainty for the company. Why is it? Because they access some data from industry sources, and it suggests that the company has taken a price cut of around 8 to 9% in their key sub 20 metric ton category across its key ports from the 1st of May. In fact, they've taken a higher price cut of almost 12% in the export pricing in the Pipavav port. And this is the first such instance of meaningful pricing cuts by Container Corp over the last 5 years. And this may actually reduce the premium that Container Corp charges to its other competitors as well. And more importantly, from October 2023, there will be a change in the CMD of Concor. So that opens up the scope for accelerating cuts, or that may be the strategy of the new management, is what they are guessing. Also, their thesis is that competition coming in from peers like Gateway Rail as well as Adani Logistics will only increase the costs and pressures for Container Corp. So that means that in the near term, there could be margin uncertainty for them, and as a result of which, it's better to sell.
All right, thanks for that. Well, Nimesh is also tracking Timken this morning. Nimesh, why is that?
Hi Sonia, so even in Timken there was a large block, nearly 8.5% equity got changed hands. The promoter entity, which is the parent, was a seller in today's block. The block happened around 10% discount, and then you've seen a bit of a recovery as well, largely because some domestic mutual funds were anchor investors in the Timken block. So the promoters have now sold 8.5% stake. Their stake goes down from 68% to around 61%. It was a bit mysterious that why the parent has sold and raised $250 million by selling this particular stake. But in terms of buyers, some domestic mutual fund is what I understand were buyers in today's block. So the block happened at a 10% discount, and after that, some bit of recovery in Timken as well after a large block by parent.
All right, thanks a lot for that, Nimesh, and thanks to Mangalam as well for giving us all of the buzzing stocks. Let's slip into a quick break. On the other side, our special Indianomics segment coming up. Lata Venkatesh will connect with TT Jagannathan of TTK Prestige, Atul Lal of Dixon Technologies, Anuj Poddar of Bajaj Electricals, and Akshay D'Souza of Bizom to discuss the demand trends in the consumer durable sector. Stay tuned.
Welcome to Indianomics. Our focus today is on the consumer durable sector. Fourth quarter results showed that COVID-related declines in spurts are behind us. The electronic consumer durables industry grew at a 3-year CAGR, a compounded annual growth rate of 12% from FY20 to FY23, which is close to the pre-COVID pace, largely. Cables grew by 17%, much better, that's the 3-year CAGR, and air conditioners grew by a more tepid 10%. While these numbers look good, the GDP data for the fourth quarter showed that consumption for the country as a whole grew by only 2.8%. Now, Q1 is coming to an end in 10 days, and it's a good time to check, firstly, if the long-awaited rural demand arrived in style in Q1, and 2, how will the upcoming festival season shape up? That is, has stocking for Q2 already begun, and if it has, what are the early signs? Joining me are all the veterans of the industry, Mr. TT Jagannathan, Chairman, TTK Prestige, Atul Lal, Managing Director, Dixon Technologies, Anuj Poddar, Managing Director, CEO, Bajaj Electricals, and Akshay D'Souza to give us the outside sector view, Chief of Growth and Insights at Bizom, a market research company. Gentlemen, thank you very much for joining me. Mr. Jagannathan, may I start with you? We have, kitchen appliances, we have, other consumer durables like refrigerators and electrical goods, and we have mobiles also covered with our guests. But let me start with what is even most important, kitchen appliances. How was Q1, April, May, June? Was it an improvement over Q4? Could you actually see rural demand shaping up?
Well, Q1 was similar to Q4. I won't say it was any better than Q4. And rural demand is looking good.
You mean it fired up? It was better? Because, in Q4, there were people complaining that the Rabi harvest is not in. There were unseasonal rains, extremely warm February. So people complained about rural demand in the first quarter of the calendar year. Did it improve, with the Rabi harvest in?
Well, actually, our rural demand does not depend on the harvest. It depends upon how many induction cooktops are sold in rural areas and followed by pressure cookers.
Okay. Well, let me come to you, Anuj. What was the experience in Q1, April, May, June?
Lata, I'll first answer you on the rural, but I'll add another angle to this, right? I do think, and I'm going to say this very cautiously so that people don't overread into this. I do think we're starting to see some pickup in the rural demand, and it's slightly outpacing urban is the trends that we're seeing the last couple of months. But the data is too shallow right now for us to read too much into it. But the other point I really want to highlight is, while the kitchen appliances has been soft, the cooling appliances has had a very interesting 3 to 4 months. And I think that's dictated more by weather patterns than by the economy. You had this almost yo-yo of the heat wave, then unseasonal rains, little cool off, back to heat, intense heat, etc. And that's really dictating the demand for, when I say cooling products, in our case, we're talking coolers and fans. We've seen that yo-yo in demand. Right now, speaking, June is extremely hot in many parts of the country. You're seeing very strong tertiary demand. At the same time, primary demand is a little soft because I think the channels are also a little confused. So should they stock up? Should they not stock up? But I would just sign off on the good news that at least tertiary demand, because of the intense heat, is looking good right now.
Okay, so not a very interesting April, May, but a very good June. Is that what you're saying?
So April again, so it's a little bit of a yo-yo because you had in different parts of the country heat and unseasonal rains. But we did, predictability has become very difficult. So we tempered down our expectations, suddenly almost stocked out of coolers, which is a good news in a way. But then, as you start stocking up, it becomes difficult as to plan for inventory, etc. But my larger point is the weather is playing a bigger role right now than economy.
I'm looking for a number, Anuj, year on year.
We are in
would it be double digits? No, I understand. I understand it will be an approximation. But will it be 10, 12?
So we're not back to those kind of demand levels of double digits. I do think we are on an overall at an economy level. We do face headwinds right now. So I think these are silver linings, but we're not in the...
Not in the double digit yet. Fair enough. Thanks for that. Mr. Lal, the expectation is most from you because mobiles now have become more necessary than anything else. How was Q1?
So please appreciate that we are a B2B company and we are subservient to the brand owners. So there is a certain lag with which we operate in our domain. So Q1 has been subdued, but a slight growth, not excessively buoyant. But in the last 2 to 3 weeks, when we interface with our brand owners, we get an impression that the tertiary sale is picking up pace. And also significant thing is that earlier, the lower price goods were just not taking off. So one can see some traction, a positive traction in that domain, which means, which we gather, that the rural demand is looking to be better. However, we are just around the festive period. We're getting a pretty healthy forecast across at least some of the product lines. We're getting a very healthy forecast for a television business, for a washing machine business. And one product category which is doing really very, very well is wearables and wearables, the TWS, the smartwatches, that is booming.
Okay.
So it's that kind of situation.
Okay. Mr. Lal, if you can put some numbers. I mean, you said that premiums were doing well, and now lately you have started seeing the economy models in mobiles also doing well. Is that how we should understand?
So I can see some movement there.
Okay, but if you could put some numbers at all for any of them, I mean, either for the if you can give them for all of them, it would be great. But approximately, are you at 5%, between 5 and 10? Are you at double digits? Especially because you said wearables and consumer durables are doing very well.
So across the various product categories, it will be a single-digit kind of a growth in the product categories of televisions and mobiles. It will be high double-digit growth in wearables, mid double-digit growth in washing machines. In the space of lighting, it's going to be low single-digit kind of growth.
Okay.
So that kind of mix is there.
Okay. So the white goods washing machines are the ones that are doing the best. Okay, now let me go to the man who is cutting across brands and looking at the sector. Akshay, what's been the consumer durable performance? I know your weight is more in FMCG, but I want to know the consumer durable performance.
Sure. So thanks, Tata. So one of the things that we actually track for consumer durables is their sales in stores and not really any online sales in this particular case. One of the things that we're seeing is, April, May, especially lean very heavy on summer product sales for the category. And especially, you have your coolers and ACs and, refrigerators. I think these have taken a hit. So I think April and May, they've taken a hit. And I think June is trending positively compared to last year.
Okay.
These are all April on April from last year, from our data. We actually had a good end to the JFM quarter.
Okay.
I think some of that would have also weighed heavily on April because some of these financial year ends stocking would have actually not got liquidated, and hence April sales would have got impacted by that.
Okay, I got that. We are running your numbers, 11.8% in Jan, Feb, March. So almost 12%, probably overstocking, and therefore you saw an April, which is pretty bad, 17, nearly 18% lower and 12% lower for May as well. So clearly the heat has impacted some of the movements of goods. But let me come to premiumization. Mr. Jagannathan, was there a preference for premium products over mass products?
Yes, there was, clearly.
Okay. Would you be able to give some numbers on, whether premium products touched double digits or were they high single digits? Just an approximation. I know I'm catching you unawares in the middle of the quarter.
Well, I would say high single digits.
For the premium products?
Yes,
for the premium products, you mean?
The premium products, yes.
Okay. And mass products, were they flat or did you even see contraction?
We saw some contraction.
Okay, because that was your experience in the fourth quarter as well. So mass products did see contraction.
Yes.
Anuj, was there a preference for premiumized premium products?
So no, I would agree with what Mr. Jagannath also said. What the data is pointing out. For us, you need to understand we've been coming from where we are a non-premium brand to actually starting to add to that segment. So for us, we are seeing that growth and catch up happening.
Okay.
I actually want to go back to that data that you put out on April, May, June. That is pretty much mirrors that. We've all seen a downtrend in April and May, but now you're starting to see an uptick. So we don't know how the quarter will aggregate out, but we are, I think the quarter will probably end better than it started off.
Okay. Time permitting, I'll come back to analyze why would you think that, April and May did like that? Was it all due to weather or were there other problems? Because it worries everyone that the Q4 consumer data from the GDP actually showed a growth of only 2.8%. That was not a very flattering number at all. Okay, Mr. Lal, you had started off the conversation on festive season, so let me ask you about that. How is the July, August, September looking like? Do people already start placing orders by June end itself? And if they have, how is July and August shaping up?
So July, August, September forecast across all the product categories is extremely healthy.
Oh, good.
Is significantly better than what it was last year. So we're extremely buoyant about it, boisterous about it. The order book is very healthy across all categories.
All right. If you could put some numbers, again, broad ranges only. When you say significantly better, what do you mean?
So let's say in mobile, we feel that it's going to be more than 20-25% of last year. Similarly, in washing machine, I find similar kind of numbers. In lighting, I'm still finding it quite flattish. In wearables, I feel it's going to be high double digit, even more than 20%. So all this looks quite buoyant.
What did you say about mobiles?
So mobiles for us, the order book is looking good.
Okay. You don't want to put a number over there, a volume number?
I don't want to put in a number as of now.
Okay, but washing machines and wearables, you say, are doing the best. And it's as high as 20-25.
Even in television, lower end of double digit, we feel that we're going to have it. That's what the order book is looking like.
Okay. Mr. Jagannathan, would festive season hits early in the south. You will have Onam by August end or early September, and you will have Ganesh in Maharashtra and a better part of the south by mid-August. Do people start stocking now? How has the experience been?
In the third quarter.
Okay. So you don't get any advanced stocking trends as early as this?
I'm sorry, I said that wrong. In the second quarter. They'll start stocking up in the second quarter.
Okay.
And we expect a very good third and fourth quarter.
Okay. That's good to hear. Anuj, what about you? Do you get, what are the early stocking signs?
No, so it's very early to say, honestly, Lata, but the way I see it is the bad news is behind us, right? You're well past peak inflation. You're seeing rates come down of commodities. I think you're well past interest rate hikes. If not reduction, at least they will plateau out. So I think that, to me, are the two big factors that have held back demand in the last year. And, these things, the bad news being behind us, I think it's a matter of time before demand comes in. And I think a lot of what we are doing as brands, and to what Atul mentioned, is really in the optimism that demand will come back, that as brands, we are starting to stock up and make those advanced purchase orders, etc. I think we are the ones who will really drive the channel stocking up in that sense. The good news there, like I said, is June, you're starting to see good tertiary sales, if not primary sales. So that's only good news for us, that the channel will be probably more receptive to now taking in more stocks coming into Q2 and into festive.
Okay. Gentlemen, I do have to ask you about inflation and margins. Will the second half be a period when margins will recover because of raw material prices? Those questions in a minute after this break.